Bitcoin's volatility is shaking everyone out, and if you're feeling tense watching a 30% drop, here's the uncomfortable truth you probably don't want to hear. The people panicking right now aren't reacting to price. They're reacting to a misunderstanding that quietly drains money every single cycle. And if you don't catch it now, it doesn't just cost you returns, it costs you conviction right when it matters most. Because here's the part nobody tells you up front. Bitcoin didn't become volatile after you bought it. The volatility was always there. What changed is your expectations. And when expectations collide with reality, that's when people get shaken out at the worst possible time. Think about where you are right now. Bitcoin was at one price not that long ago. Now it's down hard. Headlines are loud. Social feeds are split between "this is the end" and "buy the dip." And somewhere in the middle is you, asking the same quiet question everyone asks in moments like this. Is this normal, or did I miss something important? That question matters more than the price itself, because volatility doesn't hurt people who understand it. It hurts people who expected something else. Most investors don't lose money because they picked the wrong asset. They lose money because they expected a smooth ride from something that has never been smooth. Bitcoin is doing exactly what it has always done. The problem is that most people don't realize what they signed up for until the price moves against them. And when it does, their brain fills in the blanks with fear. Let's slow this down for a second, not to calm you, not to reassure you, but to make sure you actually understand what's happening instead of reacting to it. Bitcoin is volatile. That part is not debatable. It moves more in a month than some assets move in years. But volatility by itself is not a flaw. Volatility is a measurement of energy. It tells you how much an asset moves, not whether that movement is good or bad. Cash barely moves. Bonds move a little. Stocks move more. Bitcoin moves a lot. And that's the entire reason people were drawn to it in the first place. You don't get outsized upside without outsized movement. Those two things are welded together. You cannot separate them no matter how much you want to. But here's where things quietly break down. People want Bitcoin returns with stock market emotions. They want explosive growth with gentle pullbacks. They want a straight line up, even though no asset in history has ever moved that way. So when Bitcoin drops 30%, it feels like something went wrong. It feels like failure. It feels like danger. But from the asset's perspective, nothing unusual is happening at all. A 30% move in Bitcoin is not a signal, it's a feature. That sentence alone makes people uncomfortable, because if volatility is normal, then panic stops being justified. And if panic isn't justified, then the real problem moves closer to home. The truth is, volatility only feels unbearable when you didn't plan for it. Most people don't realize this, but they walk into Bitcoin with two completely different expectations fighting each other. Consciously, they say they're here for the long term. Subconsciously, they expect short-term comfort. Those two things cannot coexist. You cannot hold a high-energy asset with a low tolerance for discomfort. One of them will break, and it's almost never the asset. This is why Bitcoin volatility shakes people out every cycle. Not because the moves are too big, but because the expectations were too small. Let me put this into plain language. If an asset has the ability to go up 50% in a year, it must also have the ability to go down dramatically along the way. There is no version of reality where you get one without the other. The upside is powered by the same engine as the drawdowns. When people say Bitcoin is too volatile, what they're really saying is, I want the upside without the emotional cost. And that's not an investing strategy. That's wishful thinking. This is where psychology enters the picture, and this is where things get dangerous. And humans are wired to feel losses more intensely than gains. A drop hurts roughly twice as much as an equivalent rise feels good. That's not opinion, that's biology. Your brain is designed to notice danger faster than opportunity. So when Bitcoin drops, your nervous system doesn't analyze probabilities. It looks for threats. Suddenly, every headline feels heavier. Every negative opinion feels smarter. Every scary scenario feels more likely than it actually is. You start hearing things like, What if this time is different, even though you've heard that exact sentence in every prior cycle? And the worst part is, your brain feels rational while doing it. That's why volatility is so effective at redistributing assets. It doesn't force you to sell, it convinces you that selling is the smart choice. This is the moment most people misunderstand. Markets don't take your money. You give it up when uncertainty feels unbearable. And here's the critical piece. Volatility only becomes unbearable when you don't know why you own what you own. If you bought Bitcoin because the price was going up, then price drops destroy your confidence. But if you bought Bitcoin because of what it represents, price drops test your patience instead. Those are very different experiences, and most people never take the time to build a real thesis. They borrow conviction from influencers, headlines, or past performance. And borrowed conviction evaporates the moment things get uncomfortable. You can't outsource belief, especially not in a volatile asset. Let me give you an analogy that makes this painfully clear. Imagine you buy a piece of land outside a growing city. You don't buy it because it looks nice today. You buy it because you know a stadium is being built nearby in 7 years. That's your thesis. Now imagine that a year later, similar land nearby sells for less than what you paid. Do you panic? Only if you forgot why you bought it. The first thing you check isn't the price. It's the plan. Is the stadium still happening? Are permits approved? Is construction moving forward? If nothing about the thesis changed, the lower price isn't a threat, it's information. Bitcoin works the same way. Price movement is not the story. It's the noise around the story. If your only reason for owning Bitcoin is that you expected it to go up quickly, volatility will feel like betrayal. But if your reason is rooted in scarcity, decentralization, and long-term monetary shifts, volatility becomes part of the process. That doesn't mean it feels good, it means it feels expected. This is why experienced investors ask a different question during drawdowns. They don't ask, why is the price falling? They ask, what changed? If nothing fundamental changed, then the drawdown is not a signal to exit. It's a stress test of your time horizon. And here's where most people quietly fail. They use long-term language with short-term money. They tell themselves they're investing for the future, but they emotionally need the money to behave well right now. That mismatch creates pressure. Pressure creates forced decisions. Forced decisions destroy outcomes. And this is why one of the most important rules in investing isn't about timing or picking assets. It's about never becoming a forced seller. If you need the money soon, volatility becomes an enemy. If you don't, volatility becomes survivable. Bitcoin has never rewarded impatience. Not once. Every major drawdown in its history felt catastrophic in real time, every single one. And every single one later looked like a redistribution event, where assets moved from those who couldn't tolerate uncertainty to those who could. That's not manipulation, that's psychology playing out at scale. Now here's where people make a well-intentioned mistake. They tell themselves they'll just sell and buy back lower. It sounds logical, it feels proactive, and it almost never works the way they imagine, because timing volatility is harder than enduring it. The biggest up days in Bitcoin often happen immediately after the worst down days. Miss a handful of those days and your returns collapse, even if your long-term direction was right. Waiting feels safe. It feels cautious. It feels responsible. But in volatile assets, waiting is often the most expensive decision you can make. This doesn't mean you blindly hold everything forever. It means you understand what kind of asset you're dealing with and you align your behavior to it. Bitcoin is not a calm asset. It is not designed to feel comfortable. It is designed to reprice aggressively as adoption, liquidity, and narratives shift. Expecting calm from it is like expecting silence from a crowded room. You're setting yourself up to be disappointed. Here's the reframe that changes everything, and I want you to really sit with this. Volatility is not the enemy of wealth creation. Misaligned expectations are. That sounds simple, but It's one of the hardest things for people to actually internalize, because most of the pain people experience in markets doesn't come from price movement itself. It comes from the story they told themselves before the movement happened. They expected progress to feel calm. They expected growth to feel reassuring. They expected being right to feel obvious. Markets don't work that way. Once you internalize this reframe, the emotional experience changes. Not because the price suddenly behaves better, not because volatility disappears, but because you stop interpreting every move as a verdict on you. Right now, a lot of people are subconsciously asking a question they don't even realize they're asking. Was I wrong? And every red candle feels like the market answering that question directly. But price is not a judge, it's a messenger. And most people confuse the two. Bitcoin's volatility isn't shaking people out because it's dangerous. It's shaking people out because it exposes who never truly accepted what they bought. They accepted the upside story. They accepted the screenshots. They accepted the past returns. But they never accepted the full behavioral cost of holding a high energy asset through uncertainty. That acceptance only gets tested when things get uncomfortable. And there's one more layer here that almost nobody talks about. Volatility doesn't just test patience, it tests identity. When price is rising, everyone feels competent, everyone feels validated. You don't even have to think that hard. The market does the emotional work for you. But when price is falling, the market turns the mirror around. Suddenly, it's not just about money, it's about judgment. It's about intelligence. It's about whether you trust yourself. You start replaying decisions. You start comparing yourself to others. You start wondering if you should have known better. That's why this feels personal. The market isn't just moving numbers on a screen. It's pulling on ego, fear, self-doubt, and the part of you that wants certainty in an uncertain system. But here's the part that changes how you see all of this. The market isn't judging you. It's revealing you, and it's revealing how you react under pressure. It's revealing whether you built conviction or borrowed it. It's revealing whether you own your decisions or outsource responsibility to price. If you can't tolerate the movement, you don't own the asset. You're renting it emotionally, and renters leave at the first sign of discomfort. They don't leave because the fundamentals changed. They leave because the emotional cost got too high. They leave because holding no longer feels good. Owners think differently. Owners don't ignore volatility. They contextualize it. They don't ask, why is this happening to me? They ask, does this change why I bought? They don't zoom into every hourly move. They zoom out to the broader picture they committed to. They treat price as data, not as a diagnosis. Data gets analyzed. Diagnoses trigger panic. That difference alone separates people who survive cycles from people who relive the same regret every few years. And yes, that way of thinking takes practice. It's not natural. Your brain is wired to react quickly to perceived danger. The skill isn't eliminating emotion. The skill is not letting emotion make decisions for you. Now let's bring this back to where you are right now. If Bitcoin's volatility is making you uneasy, I want you to hear this clearly. That discomfort is not random. It's not meaningless. It's information. But it's not information about Bitcoin. It's information about you, about your expectations, about your time horizon, about how much emotional exposure you actually took on when you hit buy. Most people misread that signal. They assume unease means danger. They assume discomfort means something is wrong with the asset. They assume fear means they should exit. But more often than not, it means something is misaligned internally. And that doesn't make you stupid. It doesn't mean you failed. It doesn't mean you shouldn't be here. It means you're learning in the only way markets actually teach people. Through pressure. This is the part no one prepares you for. Volatility isn't just a price phenomenon. It's a mirror. It reflects back the parts of your strategy that were vague, the parts that were borrowed, the parts that sounded good but were never fully stress tested. When the price was calm, those weaknesses were invisible. When the price moves hard, they become impossible to ignore. So when you feel that knot in your stomach, the mistake isn't feeling it. The mistake is ignoring what it's pointing to. Because the worst decisions don't come from fear itself. Fear is normal. Fear is human. The worst decisions come from reacting to fear without understanding it. That's where people go wrong. They feel the discomfort and immediately try to make it stop. They don't pause, they don't zoom out, they don't ask better questions, they just act. And action taken purely for emotional relief almost always shows up later as regret. Real adjustment looks very different. Adjustment doesn't start with selling or buying. It starts with reflection. It starts with asking better questions instead of demanding immediate certainty. Questions like, why does this move feel bigger than I expected? What assumptions did I make that aren't holding up right now? How much time did I honestly give this investment? Not on paper, but emotionally. For some people, the answer is position size. They didn't invest too much financially. They invested too much psychologically. Every tick of the price feels personal because the position is too large relative to their tolerance. So the market isn't just volatile, it's overwhelming. For others, it's realizing they said long-term, but they meant comfortable. They wanted growth without stress, and volatility exposed that mismatch. And for some, it's realizing they never truly finished the thinking process before entering. They entered with hope instead of clarity. Those realizations are uncomfortable, but they're also valuable, because once you see them, you can adjust without self-destruction. And that's how people stop getting shaken out. Not by predicting the market, not by eliminating volatility, but by aligning themselves with what volatility actually demands. For others, it's time horizon. They said long-term, but they meant a few months. They told themselves a story that sounded patient, but their nervous system was wired for short-term comfort. And for some, it's deeper than that. It's realizing they never truly built their own thesis. They relied on momentum, consensus, or someone else's confidence. And now that the crowd is quiet or scared, there's nothing solid to stand on. Adjustment doesn't mean abandoning the asset. It means aligning yourself with reality instead of fighting it. Sometimes that means scaling back so you can think clearly. Again, sometimes it means extending your time horizon so daily moves stop feeling like emergencies. Sometimes it means stepping away from the price entirely and rebuilding your reasoning from scratch. What it never means, if you care about long-term outcomes, is panic selling just to feel relief. Relief feels good in the moment. It feels like control. It feels like safety. But in volatile markets, relief is one of the most expensive emotions you can buy, because relief usually comes right after selling, and regret usually comes later, when the price recovers and you realize you didn't solve the problem. You just postponed it. The people who make it through multiple cycles aren't immune to fear. They don't feel less. They don't magically stop caring. They're clearer. Clarity beats courage every time. They know why they're here, not in a vague way, in a grounded way. They know what problem the asset solves. They know what kind of movement is normal. And they know the difference between volatility that tests patience and events that actually break a thesis. Because of that, they don't confuse noise with failure. They don't treat every drop as a verdict. They don't assume every uncomfortable moment is a sign they were wrong. They let time do the heavy lifting instead of trying to outsmart every move. Bitcoin volatility isn't going away. It never has. It existed when nobody cared. It existed when everyone was euphoric. It exists now. It's the heartbeat of a living, evolving system that's still finding its place in the world. The heartbeat will sometimes race, sometimes it will slow, sometimes it will feel irregular. That doesn't mean the system is dying. It means it's alive. The only real question is how you're going to interpret that signal. You can keep treating the heartbeat like a warning siren, like something to escape from the moment it gets loud, or you can start recognizing it as the cost of participation in something that doesn't move politely. Once you see that clearly, the emotional experience changes, not because volatility disappears, but because confusion does. If you want to keep learning how to think clearly during moments like this, I've opened a free educational Discord where we break these ideas down in real time. No hype, no noise, no pretending volatility isn't part of the deal. Subscribe.